on paper, then nobody is supposed to receive interest on capital. Whether you contributed 3 times more than your partner or not, no. The court says no, you share it equally. Every partner may take part in the management of the business. So here, the court is saying that according to that portion of the act, every partner can what? Walk into the business and then what? Operate the business. 3, no remuneration are to be paid to partners. So if you decide to be an active partner, according to the act, no remuneration should be given you. 3, any advances, that is loan, made by a partner maybe you, the partners, have put something down and said, no, it will attract so much as a percentage. Then, and also the remuneration, if you people have put something down and state that the remuneration will be paid, it means this one will not work. You, the partners, come together and you decide to state otherwise, then what you, the partners, have stated and append your signature to, that is what will be applicable in the firm's business, and that no person may be introduced as a partner without his consent and the consent of all existing partners. This person is a good, is also coming to join us. No, the partners must agree, and the person himself too must agree before. If the person must agree and the partners must agree, it should be in writing, not verbal. Okay, the partnership books of the firm, nobody can take it home. Now, what about accounting requirements? What is required of partners? Every firm shall cause to be kept proper accounts with respect to its financial position and changes therein. 2, the control of and accounting for all properties acquired. 3, every firm shall, at interval of not more than 15 months, cause to prepare financial statement, and this is captured under section 32. So what he's saying is that partnership as a business, one must prepare its financial statement. And one key financial statement that must be prepared is statement of financial position and statement of changes in equity. And for partners, they don't prepare statement of changes in equity. They prepare profit and loss appropriation account. Okay, so this is what the act is saying. And just as any other business, it is expected that partnership must prepare their financial statement, file it at the Registrar's General's Department and at the Ghana Revenue Service for tax purposes. So it's very, very important. Partnership and other forms of businesses. Now let's compare partnership with other forms of business organization. Now, we have the one at the extreme left. Sorry. He has an idea, but he is supported by family, and his business is very risky, excessive risky. And that type of business will be what? What form of business would that be?
Sole proprietorship.
Next time, put up your hand. Okay?
Okay, sir.
All right. Thank you. That's sole proprietorship. Then you have another form of business whereby they put their acts together, they join hands, and then even try to bring others in to run the business. And what form of business would that also be, in your estimation? Okay. Stephen Akorawo.
Sir, please, partnership.
Partnership. The second one will be partnership. And the last one, where there are a lot of people trooping in and they are all interested in running the business and they come together and they have what is called shareholder power. What sort of business would that be? Tomia?
I think that will be limited liability company.
Limited liability company. Okay, thank you. So you've got it right. The first one down here, extreme left, is sole proprietorship, very risky in nature. They only get support at worst from family members or a credit union, savings and loans who take advantage of them. Banks and good formal financial institutions don't like dealing with them that much because their business is very risky. They don't have anybody controlling them. They take decisions at will without consulting a third party, and they can dissipate the money anyhow. Partnership then becomes where two or more people come together and they're able to pull their resources together, raising a substantial amount higher than that of a sole proprietor, and they share ideas. And there is a bit of control, and the risk level too is minimal as compared to sole proprietor. Then the most secured one is the limited liability company. That is the most regulated businesses when it comes to Ghana. Limited liability companies are highly, strictly regulated as compared to partnership and sole proprietor. So they are able to raise huge capital by way of floating shares, floating equity shares, floating preference shares, floating bonds, floating debenture stock, and even going to take loans from the banks and financial institutions, or even getting a bailout from state institutions or national or government. So these are the most regulated and well-structured business in the world. So now, if you compare partnership to sole proprietor, when you talk of membership, partnership has a minimum of 2 and a maximum of what? 20, with the exception of professionals who are acting, with the exception of professional firms. So professional firms like what? Chartered accounting firms, law firms, they are giving some exemption. But what about sole proprietor? It is just one-man show. He or she alone run his or her own affairs. Profit and loss sharing. Partners share profits. All partners share profit and they also share in losses. Sole proprietor enjoys the profit alone and also bears all the risks and the losses alone. Capital contribution, larger resource from shared contribution from partners, but relatively small resource provided by the sole owner. Decision making, collectively made by the partners with shared risks and responsibility, although decision making could be slow as compared to sole proprietor. Sole proprietor decision made by sole proprietor, sole owner, who bears all the risks and responsibility. All decision making could be quick without a second thought. Then we come to final account. So partnership prepare income statement, profit and loss appropriation account, current account, capital account, statement of financial position. But what about sole proprietor? They prepare income statement and statement of financial position, just these two accounts. Right. Now we come to partnership and company. As usual, minimum of 2, maximum of 20, except professionals. But in Ghana, a minimum of 1 person can form a company in Ghana, and a maximum of 50 when it comes to private companies. But with public companies, infinity, as many as possible. Okay. Then, separate legal entity. When it comes to partnership, they are not separate legal entity unless it is incorporated. They are not separate legal entity until they go to the Registrar General's Department to incorporate and register the partnership. But with companies, you can't even form a company without registering. So with company, it is a separate legal entity which can be sued and which can sue and be sued in its own name. Okay, it has all its own rules and regulations. So it is an artificial legal person. Then separation of ownership from management. Ownership is not entirely separate from management because partnerships are unlimited liability businesses. So they are more or less like sole proprietors. And so they are not separated from the business. But when it comes to companies, ownership is entirely separate from management. Owners are shareholders. Management are board of directors. So shareholders are entirely separate from board of directors. Shareholders appoint board of directors to go and act on their behalf. And the board of directors also use the power given them by shareholders to appoint management staff. And management staff reports to board of directors, and board of directors also report to shareholders. That is how come board of directors must once in a while meet and then look at the work of the management staff and then give a go-ahead for their action or turn it down and be able to safeguard the shareholders' fund. So if this is it, then why is it that the collapse of the banks, which saw one of the CEOs being jailed? What about the board of directors? Where were the board of directors when this gentleman was acting wrongly according to the... Let's continue. He's a man of God. They decided to sacrifice that gentleman, and that gentleman is languishing in jail. If the order for the CEO to act wrongly, is it not the board of directors? And the board chairman is wearing curtain, making noise that God is good, God is good 3 times. We are not serious. Partnership is regulated by IPPA 1962, Act 152. And then company is company's code. This one is company's code. Go and look for the acts establishing companies. The act has been, the code has been. What are the accounts prepared by a partnership business? The statement of financial position, capital account, and what? Current account for each partner, so that the tax authorities will know taxes. Okay, right. Let's make progress. Please, if you have a question, you can just raise up your hand and then let me give you the hearing. Okay, when we say profit and loss appropriation account, what does it mean? When we say profit and loss appropriation account, what does it mean? A typical profit and loss appropriation account is made up of interest on capital. This gives recognition to partners contributing different amounts of capital to the firm. Even though the Act says partners must contribute capital equally, if the partners say no, we are not all of the same financial muscle, so we stagger it, then it is just right to respect and encourage variations in capital contribution by giving a percentage of the profit as well, interest on capital. Salary, annual, of course, not to be confused with salaries of what? Salaries paid to employees, which are expense in the income statement. So what we are saying is that if you see salary to a partner, it is not an operating expense. It is a residual profit item. So salaries of workers is an operating expense, but salaries of partners is an appropriated item. So take note of these two differences. Then there is interest on drawing, also in appropriation account. So in appropriation account, when you see salaries in appropriation account, it means it is for a partner. It is not the salaries of workers. Interest on current account, share of profits. These are the items you see in the profit and loss appropriation account. And this is a typical profit and loss appropriation account. This is a typical profit and loss appropriation account. So you have the net profits brought down, meaning that you have to do the income statement and derive the net profit or loss and then bring it to the appropriation account. Then if there is interest on drawing, it members' drawings in the business. Then interest on current account, debit. You know, partners operate current account. And a partner decided to withdraw to the extent that the account is showing a debit balance. What it means is that that partner has withdrawn to the extent of taking another person's money. If that is the who over withdraw, and touching other partners' money, and encourage debit balance of interest to credit balance, then it means that partner decided not to touch his or her money. So that money has stayed in the business for the business to operate with it. But another person has withdrawn to the extent of withdrawing other people's money. So we have to punish and then encourage. So by punishing, we charge you interest and add it to the partnership income and share. And by encouraging, we pay you interest for leaving your money in the partnership business. Okay. So if we do all this, if there is partner's salary, we pay it, it's a deduction, then whatever is left is the profits to be shared. That is the profits to be shared. So the profits to be shared will be shared based on agreed percentage, agreed profit and loss sharing percentages or ratios. Right. Then we are told that we will be asked to prepare the capital account. The capital account is maintained to record the capital contributions of individual partners. It is credited with contributions from partners and debited with withdrawal from capital by partners. So capital account is capital account. It has a credit balance if there is money in it. And it has a credit entry if partners contribute capital. Then we have different type of capital account. We have the fixed capital account and the floating or fluctuating capital account. The fixed capital account only record capital, increases in capital and decreases in capital. So meaning that that account record increases by way of a partner contributing further capital, or by the partnership calling on partners to come and contribute more capital. Or it record decreases when a partner decides to reduce his or her capital contribution, or the partnership has asked him to come and reduce his or her capital contribution. Then we have the floating or fluctuating capital account. That is an account which, so in a situation where the business is keeping a fixed capital account, they will have to keep another account known as the current account. So the current account records all other benefits and withdrawals from this account. Because the partnership doesn't want to disturb their capital, they open a fixed capital account. But interest on share profit, interest on capital, interest on drawing, interest on debit balance and credit balance will not be recorded in the fixed capital account. It has to be taken to the current account. So any partnership business which keeps fixed capital account will also keep a current account. But if that business is keeping fluctuating or floating capital account, what it means is that it is the merging of both current and fixed capital account. So you only keep one account by merging the transactions of fixed capital and current account in one document. So this really, so if the capital account is kept, it relieves the capital account of details such as share of profit, interest on capital, and drawings, partner salary, among others. So it keeps the capital account clean. So this is a typical current account. This is a typical current account. So the balance brought down at the debit side shows that that partner has overdrawn his or her account. The balance brought down at the credit side shows that that partner is having money in the partnership in his or her account. So at the debit side, interest on drawing is a charge on the partner's benefit. Drawings, either in a form of cash or goods, it's also is a charge on a partner's benefit. Okay, so take note of that. Then we have then we go to the credit side. Interest on capital is a gain to the partner. Interest on current account is a gain. Partner's salary is a gain for the partner. Then when we finish, we compare both sides. So when we compare both sides, the balance carried down will show where it's supposed to be. Then share of profits. Share of profits that you see at the debit side will go to the credit side as a balance brought down. So share of profit, partners can, no, this share of profit that you see at the debit side, it means they made losses. They didn't make profits. Okay. Now we come to partners loan account. Partners loan account. Right. Let's move on. Partners loan account. Where a partner gives a loan to the firm or makes an advance in excess of the agreed capital contribution, the amount should be credited to a separate loan account and not included in the capital account. It's a loan, so it's not a capital account. Such advances attract interest rate of 5% according to Section 35 of Acts 152, unless the partners decide to do otherwise. On the winding up of the firm, repayment of partners' loan ranked at a higher priority to that of partners' capital. Repayment of capital loan is more serious and ranked higher than any other. Statement of financial position. Same as the statement of financial position for any other business, except that in this statement, you have a current account and a capital account put together to give the total capital of the business. So class activity, you have the reading materials there, and I've given the pages on which you can see these questions and try your hands on it. Thank you. Any question? We've come to the end of the first lecture. But if there is any question, please put it across. Let's digest it before we check out. There is a hand up here. Is it a new hand or it has been there ever since?
No, I just raised my hand.
Okay, Somia, go ahead.
Thanks so much, sir, for the lectures. Yes, so in the previous slide, as you were giving the difference between explaining between the public, you made mention that can you please elaborate the difference between, you mentioned that the number for the formation of a public company is infinity and that of the private company is 50 or so. So I just want to know the difference between the public and then the private. And then two, let me ask all the questions together. And the two, is there any law or act regulating a sole proprietor business or sole proprietorship? Because we have the Partnership Act and then we have the Companies Act, but I didn't see in your slide any act or law governing a sole proprietorship. And then three,
right.
I want to find, yes, the third question. I want to find out if joint partnership hold, or is there any joint account for partnership?
Okay.
Like partnership, do they handle joint the joint account? If yes, I have a further question to add up. If no, then I'll back up. So these are my three questions.
Okay, thank you. The third one, there is no joint partnership account. There is a business account where they have signatories to the account, just as limited liability companies also do have. There is nothing like joint partnership account. It is a partnership business account, which is open at a designated bank that the partners want. But the individuals also have their bank account, said that when profits and loss are shared, it is what? Paid into their accounts and then they deal with it. That's all.
Yeah,
Is
so
that
let
clear?
me make it it's clear. Let me make a follow-up. So in this case, how do partners do over withdrawals? Because in the explanation you made that a partner can over withdraw. So in what
Start again.
instance?
Start all over. Hello, start all over. Your network is not good.
Yes, I said, can you hear me, sir? Hello, sir. Hello, sir.
Go ahead.
Yes, I want to find out in which instance do a partner makes over withdrawal? Because in the explanation you were making a suggestion that partners can over withdraw, partners can over withdraw. I want to know
your beginning. We didn't hear your beginning at all. You go off and you come.
It's the network, sir. So I said I want to find out in which instance can a partner make over withdrawal.
So we you are asking.
Okay.
Please position yourself.
Can you hear me now, sir?
Well, so that we can help you. Okay.
Yeah,
if you like to, you can
now,
put it
sir?
in a chat. Go ahead. Let me see if I. Go ahead. Let me see if I can help you.
Yeah. So I'm asking, in which circumstance can a partner over withdraw? Because
okay. Because there's no joint account.
Yes.
Okay. The partner will be withdrawing from the company's accountant. He will be taking the money from the company's accountant.
Okay. Get you now.
Do you get it?
Yeah,
the company accountant will be writing the check for him.
Okay. All right. Thanks, sir. So
the other question, you were asking of companies.
Yes, like, is there any difference between the public company and the private company?
Yes. There are two forms of company, public and private. And there are three types of companies. Company limited by shares, company limited by guarantee, and company limit, and then unlimited companies. So we have private and we have public companies. The public companies, example is ECG, example is VRA, example is Cocoa Board, Cocoa Board and the rest. Then the private companies, as many as you can think of. Sumia.
So they are the ones that are not managed by the government, by a group of people.
Yes. Public companies are the ones managed by the government, by the states. The government appoints CEOs, government appoint board of directors and inaugurates them. The private companies, the shareholders appoint the board of directors, and the board of directors goes ahead to appoint CEOs.
Okay.
Is it clear now?
I get you now, boss. And then the third question, is there any act or law regulating a sole proprietorship?
That's good. The sole proprietorship is not regulated, though. That is why anybody at all can start a business or a pimpim store. That is why anybody at all can just be walking on our street and be selling anything at all he or she wants. That is the sole proprietor. But if the sole proprietor wants to be legitimate, at best, they go to the registrar of company and register as what? An enterprise. That's all.
Okay. All right. Thanks so much for the explanation.
In Ghana, nobody can just get up and form a company. You have to go to the registrar of company, fill a form for you to be considered, take certain documentations from you. Mandatory, you need to get 2 secretaries before you can be granted. And even you have to state the capital that you are investing in that company. And the moment you state it, then GRA will slap you with what? Presumption tax. GRA will slap you with presumptive tax. You go and pay it before you start operating. But a sole proprietor, it doesn't go through any of these things. Today, if you like, you can just go and get some 500 cedis and buy dog chains and go and start sunning the traffic and start selling. Nobody will stop you. Is that clear?
Yes, sir.
Okay. Any other question? Question time. Any other question? Okay. If no question, because we don't want to be lagging behind, let's continue. When it is time, we share off. In the course of the week, I'll share a partnership question with the class, and then we'll do it on Zoom when we meet next week. God willing, if Jesus did not come. Okay. Or if the world is not taken over by the owner. Okay. So now we want to look at single entry and incomplete record. In accounting, what is the modern day recording of accounting? What is the modern day accounting recording? In the modern day, how do we record accounting? What is the accounting recording? No idea. Hey, you people, you are wonderful. What is the modern day system of recording accounting? Don't tell me electronic. Okay, go and look for it. Let's move on. If I mention it to you, then you are lucky. So we are looking at single entry and incomplete records. Overview. Many businesses in the informal sector do not maintain proper books of account for a number of reasons. While some of these organizations may have some record which may not follow the double entry principle, others may have no records at all. Thus, the account for such organization can only be prepared from incomplete records. This session seeks to introduce students to the process of determination of profits and the preparation of final account for an organization that does not keep proper books of account. So, as a business, if you call upon your auditors to come and audit you, one of the findings they normally state is proper books of accounts were maintained. Then you know that you have scored marks for that area. But here is the case. We said these businesses, some don't even keep record at all. Some also, they keep the record, but it's not sufficient. It's not complete. It's not enough. So if such persons calls you to come and help prepare their account, then it is going to be their words against your word. What is in their head is what you document. If you are lucky, you might get a scanty record to work with. Okay. By the end of this session, you students should be able to explain how accounting equation permits the measurement of profits when accounting records are incomplete. You should be able to draw up a statement of affairs of a business with single entry and incomplete record. You should be able to determine profit from incomplete record using opening and closing statement of affairs. You should be able to deduce sales, purchases, sales and purchases figures from single entry and incomplete record. So you have a lot to do under this session. So we shall cover the topics as follows: the importance of record keeping, the basis of accounting, either cash or accrual basis, approaches to profit determination. We will look at the capital approach and then the income approach. So what are the importance of keeping record? What are the importance of keeping records? Let's brainstorm a bit. Hey, people are checking out of the class. So, yeah. What are the importance of keeping record? Yes, as many as you can say. Wisdom.
It helps to check whether the company is making profit or it's gaining or losing.
Okay, so here we are not limiting ourselves to businesses alone, even individuals as we are persons. What are the importance of keeping records? So Kofi, thank you, that's correct. Adai, Ima.
Yes, sir. So good evening from my end here. So one of the importance of keeping records is also helps in decision making.
It helps you in taking an informed decision making. Thank you. Maud. Is it Maud or Maud?
Sir, please, it's Maud.
Yo, Maud.
It helps in determine profit or loss.
It helps in determining profit or loss. Good. Gilbert Achampon.
Yes, sir. Sir, please, to analyze the inflow and the outflow of a company.
It was.
To analyze the inflow and the outflow of a company.
Good. Analyze the inflow and the outflow of the business. Right. Richmond. Nyamiche.
Sir, please, it helps you to track the business, how the business is going.
It helps you to track how the business is performing. Good. Dari Francis.
Yes, it also helps you to know your daily sales.
Know your daily
sales you make in
daily sales. Okay, daily sales. Okay. And
it helps to detect errors, fraud, or mismanagement by auditing.
NS Davo.
Sir, it helps.
NS, you can't hear you.
It helps to detect errors, fraud, or mismanagement by auditing.
It helps to detect errors. Okay. Somia. Okay.
Yes, sir. It helps in legal and regulatory compliance. As a tax file. I said it helps in legal and regulatory compliances.
It helps in filing of tax. It helps.
Legal and regulatory compliance. As in tax filing of taxes.
And regulatory compliance. That's
in tax filing and then auditing purposes.
And filing your taxes. That's okay. Collins cannot hear us. All right. Thank you, all of you, for your contribution, your rights, and all that you have said. Let's see what is on the slide. It helps you in performance assessment, isn't it? As student, your first semester results has come. Your level 100 first semester results has come. Very soon, level 200 will come. I don't know if it has come already. So based on keeping and downloading and keeping it, before the second semester exam start, you can go back and look at your performance and be able to what? Readjust yourself. It also helps in planning and controlling of operation. You said it. For tax purposes, it helps in determination of profit and loss. You are right. It's a requirement for the sourcing of funds from the banks and other institutions like shareholders and the rest. It also helps in business valuation to determine how much the business is worth. And then other extraction of, it also helps in others like extraction of trial balance, identification of errors, and then misappropriation of what? Funds. So these are some of the reasons for keeping records. Now, when we come to accounting for this non-profit making organization, we have two bases of accounting that we can apply. We have the cash basis and then the accrual basis. So now, if we talk of cash basis accounting, what does it mean? It is used when revenue is recognized on cash actually. It is used when revenue is recognized based on cash actually received, and expenses is recognized only when cash payment is made for that expense. This method is commonly used by small and petty traders who are unable to advance credits for goods sold. So when we say cash basis accounting, what we are saying is that it is purely cash and carry. And normally it is these small businesses who use this system. So you go to some of the blue kiosks, apetishi or drinking spot. Yeah, you see they've written there, no credits, or for credits come tomorrow, and tomorrow never comes. So they are dealing with cash and carry. Other businesses also write goods bought are not returnable. They are all types of words, businesses. Then we come to accrual basis. Accrual basis accounting is a system of accounting where revenue recognized is recognized, delivered, and services rendered to a customer, and expense is incurred once the benefits is derived or so for accrual basis, we are saying that so far as you made the sales, whether on cash or credit basis, and so far as you employ the worker and giving the worker appointment letter, you have accrual basis accounting. This method is what companies, this is the system they use. It is the approved basis for recording transaction by IFRS, International Financial Reporting Standards. IFRS. So that is the system that is adopted in recording financial transactions. Right. Okay. Now we come to incomplete records. When we say a record is incomplete, what does that mean? When we say a record is incomplete, what do you understand by that? Yes. Any contributions? When we say a record is incomplete, what does it mean? Randolph Boate Danso.
Yes, sir. What it means that some of the items are missing. Transactions are not recorded or are missing from the records. That's
Okay.
what makes it complete.
Perfect. Some of the transactions are missing from the records. Gilbert. Gilbert.
When records are not balanced.
Where the ledgers are not balancing. Okay. Right. Okay. Akurabo.
Yes, sir. Where financial transactions are not fully recorded, it might happen that some are not missing, but you've not recorded all.
Okay, when financial transactions are not fully recorded. Thank you. Any other person? So now let me ask, what can be some of the causes of these transactions, some of the causes of this incomplete record? What can be some of the causes of this incomplete record? What can occasion it? What can bring it about? What can bring about incomplete records? Kofi Archie.
Delay in recording might cause it. Maybe you might forgot some of the receipts.
Okay, so forgetfulness. Forgetfulness. That's correct. Any other person? Any other person? Yes, Stephen.
Sir, please, lack of knowledge.
Lack of knowledge. That's also a reason. That's correct. Lack of knowledge. Homofa. Homofa Collins.
Sir, carelessness.
Carelessness as in what?
Carelessness in recording incomplete accounts.
How can carelessness come in here? Okay, maybe lack of knowledge, so the person can decide to be careless. Okay, all right, not bad. Kwame Asari, A+.
Okay, sir. Loss of documents.
Loss of documents. Loss of documents. That's correct. Mod.
Poor record keeping.
Poor record keeping. Poor record keeping. Intentional, okay, or unintentional. All right. Okay, I think you have said a lot. Let's go to the slide. Thank you very much for your participation. Let's move on. So we come to incomplete records. Incomplete records. Okay. So he said what? Accounting records which has not been maintained according to strict double entry principle. A full record may not be available. The proprietor of the business doesn't keep full set of accounts. These are some of the reasons for incomplete record. Some of the business account accidentally destroyed or lost. So this destruction could either be intentional or unintentional. In our part of the world, Accra, every now and then there is flood chasing people in their homes, chasing people in their businesses and all that. There is also what? If it is not flood, it is what? Fire outbreak. Fire outbreak. Businesses are losing their documents every now and then, and their money and their what have you. There is no legal requirement. If there is no legal requirement, businesses will not be forced to record their transactions. So a typical is a sole proprietor. Those in the market, those in the traffic selling. There is no legal requirement for them to record what they are doing. So they don't record it. So you realize that when GRA decide, Domestic Tax Division Unit, decide to go around those who are selling petty in their shops to collect money, they tell them, me, I've not made profit. What shows that you have not made profit? Bring your record and let's see. I don't have record. Because there is no legal requirement. But if GRA should enact a law that any business that will come to you and you don't have your simple sales and purchases book, you have flouted the law and will sanction you before the court. People will start sitting up. The cost of bookkeeper is not justified. Some businesses don't see why they should employ a bookkeeper or accounting staff. They don't see the need for it. Information for preparation of financial statement can be obtained from other sources, from his head or her head. He can tell you everything from kinkering to kankering, but he has forgotten that the head is not an encyclopedia, and that he can forget about some of the records at will. So how do we determine profit or loss when it comes to these businesses? When accounting records are incomplete, profit may be determined using the following approaches. We can use the net asset approach, that is the capital approach. Based on accounting equation, the only way capital can change is either by introduction of cash or resources. Yeah, I know your time is up. I'll leave you right now. Introduction of cash or resources withdrawal of cash or resources, and then making of profits. That is the only time a business can make profit. All right, so your time is up. We got to this place. So cash book or income approach, cost rep, take note of it. In our next meeting, that is where we'll start from. Any question? If no question, you can check out and go and prepare for your next class. Thank you for coming. Respond to it before you check out. Thank you. I'm done. If no question, please, you can just leave the class.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Most welcome.
Sir,
Yes.
I'm asking if the slides are on the LMS.
No, I'll upload it.
Okay, thank you.
You're welcome. See you next week. Bye.
Bye-bye, sir.
Bye-bye.